Hmm. Hi, good afternoon, ladies and gentlemen, and welcome to this afternoon's webinar as we explore the Lion-OCBC Securities Low Carbon ETF. And today we find out what it can do for your portfolio as well as the planet. With us today is Ong Shin Xiang from Lion Global Investors, and he'll be sharing about the opportunity that is available to participate, is available for you to participate in the decarbonization journey of Singapore's real and financial economy. As he goes through today's sharing, if you have any questions, feel free to put them into the Q&A function. We will address them at the end of the presentation. With that, let me hand over the time to Shin Xiang.
Okay, thank you, Jonathan, for your introduction and inviting me on this webinar. Good afternoon, everyone. Thank you for joining us today. I'm Shin Xiang from Lion Global Investors, and you can also call me the ETF guy. And for investors who are also Korean drama fans, you can also remember me as the ETF Oppa. So like many of you out here, I used to wonder how ETFs work. I first came across ETFs more than 10 years ago when I wanted to use ETFs for my own portfolio. They are like Lego building blocks, which you can use piece by piece and mix and match to build your own portfolio. They are an extremely useful tool to help investors like you and me gain exposure to proper diversification that used to be exclusive to institutions. So I'm here today to share more about the Lion-OCBC Securities Singapore Low Carbon ETF that is designed to help investors like you and me do good for your portfolio and for our planet. Climate change is the defining crisis of our time. And at the same time, it presents both risks and opportunities. So if I were you, the first question on my mind would be, why should I care about climate risk? So we should all care about climate risk because climate risk is real. Globally, it has triggered floods, droughts, and hurricanes, causing massive destruction and the loss of lives. Right here at home in Singapore, I'm sure all of you have experienced the effects of climate change. For example, the haze from Indonesian forest fires, the flash floods at Orchard Road, or even the risk of flash floods at Yio Chu Kang and Yishun, which I read from the Straits Times last week, and the increasingly extreme and unpredictable weather patterns. So nowadays, when I step out of office to have my lunch or even buy my kopi, I don't even know when it will rain. So it's crystal clear that climate change affects you and me on a daily basis. And this is set to continue for our next generation, be it our children or grandchildren. And by being a little red dot on the world map, climate change will especially affect our home, Singapore. And if you and I travel back in time to read our primary school science textbook, we will understand that climate change primarily exists because of the greenhouse effect. And if my primary school science teacher is watching this webinar right now, I want to say thank you for helping me understand climate change since I was young. So in summary, the greenhouse effect leads to this phenomenon, and we all need to reduce our carbon emissions. Many governments worldwide have also recognized this impact from climate change and have started to tackle them. Globally, we see initiatives such as the Paris Agreement and COP26 setting long-term goals to limit global warming below 2 degrees Celsius. And at home here in Singapore, our government also laid out the SG Green Plan 2030, specifying key goals to establish Singapore as a leading green finance hub and facilitate Asia's transition to a low-carbon economy. So with the world, Asia, and Singapore all recognizing the impact of climate change, we believe it is a priority for everyone, and that includes you and me. And as my idol Peter Drucker once said, what gets measured will get improved. We have to move beyond just using economic growth to measure progress. And we see that the transition to a low carbon future is becoming urgent because it has become more measurable. Following the Paris Agreement in 2015, 196 countries have committed to a lower carbon economy. Specifically, many countries committed to net zero emissions by 2050, together with policies such as carbon tax and incentives to push through this agenda. For example, our very own Singapore government recently announced decarbonization ambitions in the February budget speech, aiming to achieve net zero emissions by 2050. And another example in Singapore would be the announcement of mandatory climate-related reporting in December 2021, after a massive market consultation. So basically, governments worldwide are now taking climate change very seriously. And if we travel back in time to 2015, when the Paris Agreement was born, awareness, conversations, and actions were triggered globally to focus on four key areas: temperature, emission goals, minimizing climate-related losses, and catalyzing climate financing. And last year at COP26, we saw further progress in achieving the main objectives of the Paris Agreement. Many important commitments were made from both the public and private sector in COP26, focusing on the how and the implementation. So this is important because climate change is a global problem that is complex, technical, and requires many different players to work together. And to me personally, the most important was strengthening the 2030 carbon reduction targets and limiting global warming to 1.5 degrees Celsius. And that progress in COP26 is important because carbon emissions have been rising in the past decade. Within Southeast Asia alone in 2018, Myanmar recorded the largest increase in emissions, being up 32% against 2017. And Singapore came in second on the same year by recording a 17% increase. And if that were to continue, climate change could reduce Southeast Asia's GDP growth by 7.5% annually until 2070. So this is very serious because it would mean a massive loss of jobs together with natural disasters. And as we see here, 20 storms and hurricanes and typhoons have hit the Philippines each year, and they are becoming more and more destructive. There are also more frequent forest fires in Indonesia, and in particular, the 2019 Indonesian forest fires led to $5 billion in losses from affected economic activities. And to put into perspective, this loss is even larger than the amount we drew from our reserves in Singapore Budget 2022. And so to tackle all these, the ASEAN community would need an estimated $200 billion in green investments annually until 2030. And being a little red dot on the world map, Singapore is especially vulnerable to climate change. We have already seen drastic fluctuations in our daily temperatures, frequency of warm days and nights, rainfall, and wind and sea levels, and more flash floods and extreme weather patterns may continue if we do not take action. And so because of all these, we see the Singapore government is already playing an active role in shifting towards a green economy. The Green Finance Action Plan was announced in 2019 to make sustainable finance a defining feature of Singapore's role as a global financial center. The SG Green Plan 2030 was also announced last year to galvanize a national movement and push across Singapore's national agenda for sustainable development. The Network for Greening the Financial System, also known as NGFS, recently also announced the appointment of Ravi Menon with the MD of MAS last year. So for those of you curious about the NGFS, it is a group of 105 central banks and supervisors which share best practices and contribute to developing environmental and climate risk management frameworks in the financial sector. And all these are important because climate change affects everyone. For investors like you and me, climate risk is both an investment risk and financial risk. There are many investors who do not fully appreciate how climate risk translates into financial risk and are not actively managing this risk in their portfolios. There are two types of climate risk. The first type is physical risk. They are easier to understand because we have been experiencing more extreme weather patterns that have triggered natural disasters, loss of lives, and also the loss of wealth. The second type is transition risk and is brought about mainly by policymakers. For example, our Singapore government recently announced additional carbon tax to force businesses to transit to a lower carbon future. And for companies that are unwilling or unable to reduce their carbon footprint, they will face the consequence of a lower share price or lower access to funding. So as investors, we need to be aware of the financial risks within our portfolios created by climate change. And because investors recognize this financial risk created by climate change, low carbon investing is gaining traction. This is because it enables the deployment of capital into projects that promote decarbonization of the economy. It has been popular among institutions, and in fact, more than 50% of Asian investors are already engaged in or actively considering low carbon investment targets. So more than ever, we need an ETF that's more representative of the global transition on low carbon and more reflective of companies that are helping Singapore transit to a low carbon economy. And by far, when investors think about Singapore, they generally look at two indices. One is the STI and the other is the MSCI Singapore Index. But do you know both of them were actually constructed back in the 1980s? So they are rather outdated and heavily weighted towards banks. So this prompted us to rethink and reimagine a new broad-based ETF that provides investors a convenient and affordable way to decarbonize their portfolios while investing in Singapore. And since Singapore is often overlooked by many, we decided to build the Lion-OCBC Securities Singapore Low Carbon ETF to offer investors diversified exposure to the growth of 50 Singapore companies that have taken action to reduce their carbon footprint. This ETF is a joint collaboration between LGI, OCBC Securities, and SGX. And it is the ETF that allows you to participate in Singapore's transition to a low carbon future. The investment objective is to replicate the IHOCBC Singapore Low Carbon Select 50 Capped Index. The index aims to track the top 50 Singapore companies, including REITs and business trusts, by free float market cap that are representative of Singapore's real and financial economy, with a focus on index decarbonization through the reduction of the index weighted average carbon intensity, also known as WACI. And these top 50 companies have passed key filters on free float market cap, carbon intensity, and liquidity. And the beauty of this index is that it is not only limited or restricted to Singapore listed companies. So foreign listed companies like C and Flex are also part of the universe. And it excludes companies that do not report carbon data, excludes fossil fuel companies, for example, Sembcorp or ComfortDelGro that owns carbon emitting taxis. And the bottom 10% with highest carbon emissions within the same sector, for example, startup within the telco sector, is also excluded. Companies with market cap more than 200 billion US dollars will have a 10% weightage cap, while companies with a market cap of below 200 billion US dollars will have a 7% weightage cap. So this is Singapore's first low carbon ETF, and it will pay semi-annual distributions. So for investors like you and me, this ETF is a convenient and affordable way to decarbonize your portfolio. And diving deeper, we decided to use low carbon and specifically WACI because it is one of the world's most measurable, trackable, and objective criteria within the ESG space, as recommended by the Task Force on Climate-Related Financial Disclosures, also known as TCFD. So WACI is basically measured in tons of CO2 emissions per $1 million of revenue. And the index decarbonization is achieved by selecting constituents with minimal involvement in fossil fuels and through the implementation of carbon performance exclusion criteria to ensure best-in-class selections based on Scope 1 and Scope 2 greenhouse gas emissions per unit of revenue. So as a result, you see here, compared to the STI and MSCI Singapore, this index has the lowest WACI of 60.9, emitting the lowest CO2 per $1 million of revenue. And from a performance perspective, based on SGX backtested data, the index also cumulatively outperformed the other two indices on the 3-year, 5-year, and 10-year time horizon. So this is an important chart because it demonstrates that you do not have to sacrifice returns in a lower carbon portfolio. The index also has 50 constituents compared to STI's 30 constituents and MSCI Singapore's 20 constituents. So being more diversified has helped to reduce volatility, which is important, especially in the volatile market we see recently. The enhanced diversification also helps to reduce maximum drawdown and improve risk-adjusted performance, as seen in the higher Sharpe ratio. And specifically, this diversification is from a lower weightage in financials and higher weightage in technology. And historically, we have also seen unicorns such as C and Flex listing outside Singapore in order to raise more capital and liquidity. So by covering Singapore companies listed outside Singapore, the index is more inclusive in its coverage of investment opportunities. And in terms of sector breakdown, the weightage in old economy sectors like financials is lower, while the weightage in new economy sectors like tech is higher. So this is unlike the STI, that has no single security weightage cap. And if you notice here, there's also zero allocation to utilities, which is a high carbon and fossil fuel sector. And these are the top 20 constituents of this index. And when we separately dive deeper and compare the top 10 constituents between this index, MSCI Singapore and STI, this feature of enhanced diversification is even clearer. The top 10 constituents of the other two peer indices accounted for more than 70% of the index, while the top 10 of this index accounted for only around 55%. And in fact, the total weights of this index only hits above 70% when we talk about the weights of its top 20 constituents. So this is important because it clearly shows the benefit of having a 7% and 10% security weightage cap to ensure diversification across stocks and sectors to reduce volatility and improve risk-adjusted performance. So with this key feature, you do not have to take excessive risks or sacrifice returns when you decarbonize your portfolio. And this helps you get the best of both worlds, where you do good for our planet and your portfolio. And when we talk about doing good for the planet, I want to share about two Singapore companies that have been doing good, but are under the radar because they are not listed in Singapore. The first company is C Limited, which is the high-profile parent behind Garena, Shopee, and C-Money. So basically, if you play video games and do online shopping like me, you will know who is C Limited. But what many do not know is its active efforts in reducing carbon footprint. For example, Shopee and Unilever recently collaborated to promote sustainable lifestyle choices, such as plant-based stain removers and the reduction of plastic and packaging by 75% to reduce carbon footprint and waste. So imagine the number of people shopping on Shopee and the effect and impact this 75% reduction can bring. And another company that has taken active steps to reduce carbon footprint would be Flex Limited, a low-profile Singapore domiciled company. But do you know it is actually the world's third largest electronics design manufacturer by revenue? It is a giant with manufacturing operations in more than 40 countries and 200,000 employees. And this is also a giant that is committed to reduce 50% of its Scope 1 and Scope 2 carbon emissions by 2030 and achieve zero waste in half of its manufacturing sites by 2025, which is just 3 years away from now. And when we invest, we want to invest in the right companies that grow. We C and Flex, we see two distinctly different companies. C is a high-profile growth company. On the flip side, Flex is a low-profile value company. But through this ETF, you get a diversified blend of both growth and value stocks bundled together while decarbonizing your portfolio and doing good for the planet. So to summarize, you gain 4 key benefits by buying this ETF. First, you will be taking action to tackle climate change, reduce carbon footprint, and decarbonize your portfolio. Second, you will be supporting Singapore and Singapore companies in the transition to a low carbon economy. Third, by doing good for the planet, you also get to capture growth opportunities of 50 Singapore companies, both locally and foreign listed. And lastly, on a decarbonized portfolio will help you manage investment risks arising from climate change. We will be listing the ETF on the 28th of April, with the first distribution expected in December. During IOP, which is now until 22 April, you will get first-hand opportunity to buy Singapore's first low-carbon ETF. And to conclude, the Lion-OCBC Securities Singapore Low-Carbon ETF instantly offers you diversified exposure to the growth of 50 Singapore companies with lower carbon footprint. These ETF will be a resilient and green building block to your portfolio. With just $1, you will be able to participate in Singapore's low carbon transition. During IOP, you can buy these ETF firsthand through the FSM platform. So please log on and ask everyone you know to search ESG for the Sing dollar counter and ESU for the US dollar counter to buy this ETF. And if you do not have a FSM account, please also open one right now. So we can all make a difference with low carbon. Change up with you and me. Do good for your portfolio and our planet. Thank you. I'll now pass time back to Jonathan.
Thank you, Shin Xiang. Okay, and I think you guys will be able to see me in a few minutes. All right, let me just quickly share with you some of the information regarding subscribing to the IOP of the low carbon ETF. So FSM1 customers, you can already begin to subscribe from 11th April till the 21st of April. And then if you are using AutoSweep and cash account, both methods are applicable. Okay, it's very simple. This is actually the article we have uploaded, and I will put the link for you in the chat section in just a moment. So what you can do is you can click on the article and scroll down. All the instructions are there. And then here's the button to click here to subscribe. Okay, it's very simple. Once you click on it, what happens is that you'll be asked to log in onto your FSM1 account. So once you log in, this window will appear. So again, all you have to pick really is the quantity in which you're going to subscribe, as well as the payment method you will use. Following that, you just need to acknowledge some of the terms and conditions. Click on these check boxes. And when you scroll right to the bottom, you'll be able to put in your order. Okay, so the allotment for this issue, again, is in full. So what happens is that there'll be no balloting. So the quantity you put in here is the quantity that you will receive. Okay. Also, at FSM1.com, we really don't want you to miss out on any of our investment ideas, including some of these like the low carbon ETF. I've just put this QR code here. If any of you are interested to follow us on Instagram, where we often put up these visual content and investment ideas that I think look pretty good. Feel free to scan this QR code and head over there. And some of you also are definitely using Telegram, 1,700 of you right now. But if you haven't joined us also, you can also scan this QR code and to come along. Again, what happens is that this is just a short little digest of the investment ideas that we put out. It's an easy way, I suppose, for you to just to catch up on the ideas. And of course, we provide a link to the articles as well for you to dive deeper into these ideas. All right, I'm going to hand the time back over to Shin Xiang because I know some of you have a couple of questions about the ETF. I'll put these links for you in the chat section so you can catch up to them later. And with that, I think I'll just hand it over to Shin Xiang right now.
Thank you, Jonathan, for showing everyone how to subscribe. It's a very, very important demo. Okay, so I've noticed some questions. So the first question I would address would be, why should investors care about climate risk? So basically, we should all care about climate risk because it is real. It has triggered floods, droughts, and hurricanes globally, causing massive destruction and loss of lives. And right here at home in Singapore, you and I also experience the effects of climate change, especially from the haze from Indonesian forest fires. So climate change affects you and me on a daily basis, and this is set to continue for our next generation. But other than our own daily lives, for investors like you and me, climate risk is also an investment risk and financial risk. It is a physical risk, which we see from extreme weather patterns that triggered natural disasters, loss of life, and loss of wealth. And secondly, it is a transition risk, which affects investors in companies that are unable or unwilling to reduce their carbon footprint, either through lower share prices or lower access to funding. So to summarize, investors should care about climate risk because it affects our daily lives and is a financial risk within our portfolios. Okay, there's a question about how did the index outperform the STI and MSCI Singapore index? All right, so to start regarding that question, from a performance perspective, based on SGX backtested data, the index cumulatively outperformed the other two indices, being the STI and MSCI Singapore, on a 3-year, 5-year, and 10-year time horizon. So this is firstly important because it demonstrates that investors do not have to sacrifice returns when investing in a lower carbon portfolio. And this outperformance observed in the backtested data of the index is primarily attributed to the inclusion of foreign listed companies at an earlier period compared to the MSCI Singapore index. But when controlled for such differences in the timing of inclusion, the performance between this index and MSCI Singapore is actually comparable. And this is expected because the index aims to track the top 50 Singapore companies that are representative of Singapore's real and financial economy, along with criteria on the minimum involvement in fossil fuel sectors and screening based on Scope 1 and Scope 2 greenhouse gas emissions per unit of revenue. So this index presents investors like you and me the opportunity to gain diversified exposure to Singapore's real and financial economy, widening the investment universe beyond just companies listed in Singapore, while reducing the carbon footprint of your portfolio. Okay, I see another question about trade-offs between investing for returns and investing for good. So, I mean, this is a relevant and important question because I also seen it being posted in the various webinars. So basically, when you and I invest, we basically look at two key things. The first is risk, and the second is returns. I already covered earlier about returns when we talk about the index outperforming the STI and MSCI Singapore index on the 3-year, 5-year, and 10-year time horizon based on SGX backtested data. But on the aspect about risk, climate risk is both an investment risk and financial risk in your portfolio, which we all have to manage. And we specifically built this index and ETF to tackle this climate risk. Firstly, the index has 50 constituents compared to STI's 30 constituents and MSCI Singapore's 20 constituents. So being more diversified is important because it helps to reduce volatility, which is important especially in the volatile market we see today. And secondly, in terms of the enhanced diversification also will help to reduce maximum drawdown and improve risk-adjusted performance, as seen in the higher Sharpe ratio of this index. So specifically for this index, the diversification is from a lower weightage in financials and a higher weightage in technology. So with this, you do not have to take excessive risks or even sacrifice returns when you decarbonize your portfolio. And it helps you get the best of both worlds, where you do good for our planet and for your portfolio. Okay, I see a question about how attractive is the ETF compared to a Singapore-focused ETF and outlook for Singapore market. Okay, it's actually a few questions lumped together, but okay, I can answer it. Okay, I'll answer the first question about how attractive is the low carbon ETF. Okay, so mainly for investors, when you want to manage or actively manage climate risk in your investment portfolios, basically there are two ways to do so. First is investing in green solutions or decarbonizing your portfolio. Investing in green solutions is direct, but specific and targeted. So they commonly have a narrow investment focus, for example, such as clean energy, and are usually a satellite allocation. But in contrast, decarbonizing portfolio is more broad-based and generally a core allocation for people keen to gain broad-based exposure, for example, such as the S&P 500. So investing through a low-carbon ETF provides you a convenient and affordable way to invest in the emerging low-carbon economy. And the Lion-OCBC Securities Singapore Low-Carbon ETF offers you diversified exposure to the growth of 50 largest Singapore companies with lower carbon footprint. So this ETF will be a resilient and green building block to your portfolio. And regarding And regarding the next question about outlook for Singapore market conditions. All right. So in short, we basically have a positive view on the Singapore stock market. And we believe strongly that 2022 will be the year where the Singapore economy will get a boost with reopening and the normalizing of travels as the world learns to live with COVID. And this has broad-based benefits to many, many industries here, especially travel, transportation, hospitality, and gaming. And within Singapore, allowing for larger dining groups itself also will boost retail spending, which will benefit retail REITs and some consumer names. Office demand will also increase as people start to work in office again. So we would also like to point out here that the recent rate hikes by the US Federal Reserve is also not negative for the Singapore market, because these rate hikes are usually performed when the economic growth are expected or perceived to be strong. So incidentally, these rate hikes actually benefits the banking sector, which is a significant segment of the Singapore stock market. And lastly, we have also observed positive sentiment from the wave of positive restructuring among some of the largest Singapore names. There's a question about the future transition for companies towards low carbon and decarbonization. So basically, the transition to net zero emissions in the next few decades is crucial in ensuring a sustainable world with manageable temperature rise. And to ensure a sustainable ecosystem, it requires everyone's efforts to make this transition towards a low carbon economy. The world leaders are well aware of this situation and have formulated policies and programs to push our agenda and the global economy towards that direction. For example, incorporating and monitoring carbon reduction targets and aiming to achieve a less than 2 degrees Celsius temperature rise by 2050. They also include the implementation of carbon trading systems to control and curb overall carbon emissions, together with the push for the use of renewable energy in energy production and transport. Singapore is no exception. As part of our SG Green Plan 2030, our Singapore government has announced several initiatives, including a maritime decarbonization blueprint that helps move the sector towards net zero emissions by 2050 through low carbon energy solutions and incentivizing ship owners to transit towards using fleets of green ships. There's also a joint effort with the private sector to develop a carbon exchange. So climate risk is also a financial risk. And in Singapore, private sector leaders with foresight recognize this and are not falling behind as they step forward in carbon reduction efforts and take advantage of the rise in business opportunities to facilitate this transition. The OCBC Singapore Low Carbon Select 50 Capped Index is meant to include such companies that have taken action to reduce their carbon footprint. So by tracking this index, the Lion-OCBC Securities Singapore Low Carbon ETF instantly offers you diversified exposure to the growth of 50 largest Singapore companies with lower carbon footprint. Okay, there's a question by Dennis. So the dividend rate of this ETF is right now around 2.9%, which is similar to the STI ETF you see and higher than the MSCI Singapore index. There's a question about, in terms of sectors other than utilities, differences in carbon intensity and the difference for between local sectors and the region. So generally, investors think that all companies within certain industries or sectors will face headwinds because of environmental concerns. For example, like utilities, transport, steelmaking, construction, or even agriculture. But with that being said, there are actually companies within each industry that are more green than others and may be able to take advantage of this more green position. So by taking a more diversified approach, like our ETF, and by picking the best in class across different sectors, that will be a strategy, a sensible investment strategy to diversify. And the added advantage from this strategy will be the diversification, which can mean lower risk and volatility compared to a narrowly defined product, which is usually focused on a particular sector. Okay, there's a question about why are stocks like Wilmar and Olam considered low carbon? Okay, to put things into perspective, Wilmar is an investment holding company that engages in the processing, merchandising, distribution of agricultural products. So it operates through segments, for example, such as tropical oils, oilseeds, grains, and sugar. And investors generally raise concerns with its operations in palm oil. However, palm oil is specifically an ingredient used in many, many different products, especially on food and cosmetics. And it's in fact one of the better alternatives compared to other oils because of its yield efficiency. So the main concern with palm oil is mainly on the palm oil practices, such as burning practice or labor issues. So it is still possible to have sustainable palm oil practices which address the main concerns with palm oil practices rather than the sustainability effect of palm oil itself. And the same applies for Olam, which engages in the sourcing, processing, packaging, and merchandising of agricultural products. So in summary, the main concerns surrounding such agricultural companies are mainly on the sustainable agricultural practices. There's a question of how often is the ETF rebalanced? Okay, it will be rebalanced semi-annually, basically in March and September. So the latest rebalancing already happened at the end of March. So the next rebalancing will happen in September. So and there will definitely be a big universe of Singapore companies to include during rebalancing, as long as we observe that they have a good carbon footprint compared to the others within their sector or within the universe. There's a question about close to 20% of the index are to the banks. So to put it to perspective, as compared to the other Singapore benchmarks, for example, like STI or MSCI Singapore, STI has roughly 46% of weightage in banks. And roughly for MSCI is roughly around 33% of its weightage in banks. But if we compare this index to these other two indices, the index actually has a significantly lower weight in the banking sector, being at around 21%. And this is possible and done because of a securities weightage cap that allows greater diversification across sectors and stocks. So there's a question about whether there are basically any other ESG ETFs listed on SGX. So globally, ESG investing is growing at a phenomenal rate and has become mainstream in many parts of the world, including Europe and the US. So Bloomberg Intelligence actually estimates that global ESG assets will hit 41 trillion US dollars this year, compared to 35 trillion US dollars in the year 2020. And this amount is expected to exceed 50 trillion US dollars by 2025, making up 1/3 of the global AUM worldwide. So it's not surprising that many asset managers are jumping on this ESG trend, especially in Singapore. And in October last year, like SAW AM already changed the underlying index of its SG-listed ETF to MSCI China Select ESG Rating and Trend Leaders Index. In November last year also, we also see UOB AM listing its APAC Green REIT ETF. But compared to the other ETFs, our Lion-OCBC Securities Singapore Low Carbon ETF is Singapore's first low carbon ETF, and it will pay semi-annual distributions. So for investors like you and me, this ETF is a convenient and affordable way to decarbonize your portfolio. Jonathan, I think we have addressed most of the questions already.
Yes, thank you, Xinjiang, for answering our questions and for also sharing about this low carbon ETF. Sorry, my computer seems to be running a little bit slower today. Well, thank you also to our wonderful audience who has also joined us today over the lunchtime. If you're keen to find out more about the Lion-OCBC Securities Low Carbon ETF, I have the link in the chat section where you can go over and you can click on it to learn more, as well as find out the steps on how you can subscribe during the IOP period. With that, I'd just like to thank everyone for being a wonderful audience. We also have actually a Q&A article that will be uploaded on the fsm1.com homepage. There were several questions posted by our IFAS research team, and Chin Xiang has also very kindly answered the questions there. So if you're very keen to learn more about it, do look forward to more articles as we cover this ETF. And yeah, that is all we have for today. Thank you so much, and we wish all of you the best in your investing journey. Stay safe and take care.
Thank you, Jonathan, and everyone. Have a great day and have a great weekend. Great long weekend ahead.
All right,
Okay.
looking forward to that. Thank you, everyone.
Thank you, everyone. Cheers. Bye.